Recording, yes. Apologies, we're flying today. This presentation is brought to you, of course, by us, but the Key Choice Group is made up of two divisions, 80 Metrics Property Investment Negotiation Solutions and Key Choice Lending. So no doubt many of you are aware the 80 Metrics is around the property investment advice, which we'll go through, and vendor advocacy, and of course, you know about our mortgage broking division, Boutique Broker of the Year 2024, and hopefully take out the big prize this year. So disclaimer, this webinar is general advice, so only doesn't take into account your personal financial circumstances. So don't think you've found a gold nugget, run away and invest. It's best to understand your position, how long you've got to invest for, your risk profile, etc. So I'm just going to start off with the difference between capital growth and cash flow areas. So it's everyone comes to us and says, well, we'd love to have the best of both worlds. So capital growth and cash flow. Unfortunately, as capital growth appreciates, cash flow tends to dwindle. It doesn't keep up. And quickly, before we get into some other parts, we'll just run through very briefly what that means. So we've got an example here of a purchase of $500,000 with some costs, stamp duty. So total investment $525,000, and we're getting weekly rent of $500 a week. So what does that mean? It's a gross yield, 26 hours a year. Of course, this is very general. We're not taking into account vacancies or other costs, but to give you an indication on yield, it's about 4.95%. That's on 500,000. But if the original purchase was at 400,000, so before the capital growth, and you had slightly less, you had obviously the stamp duty on that amount, and you were getting, sorry, 1 second. What do we got here? Stamp duty on 420, that's 21,000. So total cost 441,000. I have actually gone around in circles here. Have I got, sorry, I'm on the wrong slide. Isa, smash me. Basically, $500 a week on 500,000 is 5.2% yield. If the property goes up, because you've got great advice from 80 Metrics, it's gone up to 650,000 in 5 years. Of course, the rent doesn't keep pace with it, so the rent only goes up to 540 a week. So 540 a week on a $650,000 property is a yield of 4.32%. So as the property value rises, the rent doesn't keep pace. So people come to us and say, look, I'd love a great cash flow property with huge capital growth. It tends to be hard to get that unicorn with both. It tends to be one or the other. The other example is if you can go into mining towns, get a great yield on a property, great cash flow, but the capital growth just isn't there because transient workers. Let's kick on. So suitability, I touched on it briefly in the disclaimer about why you don't just grab the advice on where it's going to achieve some significant growth and apply it to yourself. Well, you need to understand your investment goals, your risk profile, your likes and dislikes about areas. Some people have preferences about asset type, the yield that you require, or the growth that you require. You're going short term, you want great capital growth for a couple of years and then cash out and go again, or do you want a cash flow property so you can sustain some income in retirement? Is it a balance? So it's a bit of growth and reasonable cash flow. What's your exit strategy? And there's other, could be ethical and legal considerations. So suitability, we've got Ryan and Jackie there. That's married at first sight maths. They were an amazing couple for the first day. Well, actually, as soon as they got married, she started complaining. So what looked great at the start deteriorated very quickly. So some of the metrics we've used here to ascertain how did we come to pick these suburbs? Well, we've gone for suburbs that the values of homes only, we're not going units, 550,000 to 850,000. Confidence is high in the market. We've got an URSAD, the ability for people to have disposable income. The rankings are between 1 and 10. If you've got a URSAT of 10, it means that people's rent and mortgage repayments is a very small portion of their income. But when you get down to twos and ones, it starts to be that the mortgage is a large part of their income. They haven't got disposable income over and above that. So we steered away from one. At a very minimum, we wanted to say, why is that? Well, we want people to have disposable income to be able to purchase your property when you want to exit. There's some asterisks around that. What if an area is gentrifying at a rapid rate? It might be just people are lower incomes are moving out of an area and higher incomes are coming in. But that can oftentimes take time. So you don't want to be in an area with that people are going to struggle to purchase those properties and there's not huge demand and you're left with something that you can't sell. Stock on market, we want less than 2% stock on the market and a building approval of less than 2% of dwellings over the next 12 months. So what it's essentially supply and demand, we want restricted supply. And so if there's a demand there, it really multiplies the effect of growth. Days on market, we want, we're not looking for a hot spot where a property will sell basically immediately when it comes onto the market. It's really hard to negotiate those properties, but we also don't want something that's on the market 50, 60, 70 days. You want an increasing demand in the area so you can still get good value and get in before the property prices peak. Want something that the fact about what we're advertised here is the capital growth suburb for 2026. So the price change, we want above 5% the first year, and then I've taken a selection of 10 years. Renter owner occupied ratio, we don't want any more than 35% of the area to be investors. It just means that you want owner occupied demand for your property. That will drive up prices more quickly than investor demand. You want to balance both, but you don't want to oversupply of purely investment stock. Sales, you want more than 4 sales a month in the area. So you want, you can get some distorted figures with under that, and a vacancy rate of 2% or under. So again, we're looking for high and increasing demand and low supply. They're just some of the statistics we use. How do we get the capital growth estimate? So it's machine learning, so it ingests a whole range of our indicators, including typical price, median rent, rental yield, price changes, supply metrics around stock on market and how long the inventory is lasting, demand metrics around buy or rent index, so that's a ratio of mortgage repayments versus rent. This is all probably putting you to sleep, but essentially it ingests more than 80 metrics and it comes up with an estimate of capital growth rates. Sorry, we're going backwards, going the wrong way. What's the accuracy? Well, we've back tested it over the last 50 years and it's got an over 80% historical accuracy to ensure reliability. That's terrific, but historical trends do not guarantee future outcomes. So we cannot say, well, this is definitely going to happen. You said it was going to happen. We're not going off a glossy brochure. We're backing it with as much statistical data as we can, but there's no guarantees. And I've got the quote in there. I think there's a world market for maybe 5 computers. So that was Thomas J. Watson, the chairman of IBM in 1943. He said there may be 5 computers. There's currently between 6.5 and 8 billion computers globally. So we can all be wrong, and sometimes very much so. We're about mitigating risk, and so this is a heat map of capital growth in Australia for housing with no risk factors. So these are the areas in Australia. The darker the blue, the more likelihood of capital growth. But you'll see there's some areas of inland Australia there, dark blue. Um, but there could be very, very high risks. So if you're early on in your investing days, great. You might be able to take some chances, but more likely, we live around the coast of Australia. A balanced view would be to maybe buy in areas where there's a lot of other driving forces and a lot of competition for your property. And there's a heat map with mitigated risk. So there's capital growth in these darker blue areas, but there's less risk. So what does that mean? There's good cash flow, there's low vacancy rates, mitigated risk. So you can see the changing. So we'll go back, no risk, but then mitigated risk. So we've reduced the risk, and the previous heat map was around high risk properties. This is mitigated risk. And lastly, units. So unfortunately for units, well, in areas of Queensland, some spots in New South Wales and WA, and some small parts of Adelaide, there's going to be unit growth. But besides that, again, it's housing. Housing's what we've got a demand for. So we're going to get into the numbers. Now, I haven't got a bias. Unfortunately, there's no Victorian properties in, so I would have a bias. That's just, I'll put my hands up. But the first suburb is going to be Gawler East in South Australia. There's a new, you can see the new link out to Gawler East from Adelaide. It's 40 kilometres north of Adelaide City. Why? Why is this such a good investment? Our predictions are saying about 123% growth over 10 years. Why? Again, supply and demand are a big part of the drivers of capital growth. So there's low inventory. So there's only 1.02% of the market is available. The vacancy rate is just above 2%. ERSAD is 5, which is good. So there is mid-range. There's disposable income in the area. The yield's okay, 3.73%. Again, that's why you need personalised advice, because that might be enough for some, and it might be fine for others. They can take a bit of a hit to get the capital growth, in the whole period's over 9 years. So currently, the house price is 759,000. Median rents are 545 a week. Yield 3.73. ERSAD 5, as we said. Some of the stats: units to houses, only 6% units, mainly housing. Renters to owners, only 18% renters. That's fantastic. It's a gateway to the Barossa up there. Now this is where we start to get interesting. So stock on market, you can see the top left hand, it is decreasing. You can see the gradient down, down, down. That's what we want. Days on market is shifting down. So you'll find as the demand ramps up and the supply is dwindling, the days on the market come down. The housing inventory is plummeting, and the building approvals, these figures are in hundreds of thousands. What's a building approval amounts? There's hardly any building approvals in the area. Stock's dwindling, inventory's dwindling, days on market's dwindling. There's a new Gawler link from the CBD, so it's just destined for some capital growth, I would say I've gone the wrong way again. It's like me saying, no, Isaac, can you scroll up when I mean scroll down? So it's our prediction. First quarter, in a quarter, it'll go up by 1.64, 10% growth in the first year, 41% by end of year three, 86 by year five, and 123 by year 10. Again, this is number three. We're going 3, 2, 1. Really good news story around that part of Adelaide for those reasons. Number two, Greenmount, Queensland. Well, Queensland's gone off. We've got some restrictions because of the price point. So we've gone between 550 and 850. Greenmount's outside Toowoomba, so Toowoomba's up north of it. There's Ipswich will be to the right, and Brisbane's to the right of that. So it's in inland Queensland. Wyke's the price point. The properties are gone absolutely gangbusters under there. It's hard to find anything. So why this area? We're predicting huge capital growth. The median price only 593, so it's affordable. Vacancy rates under 3, so 2.78%. URSAD is 4, so not quite as good as Gawler East, but they basically got no stock on the market. 0.28%. There's nothing available. People are holding the properties for 14 years in the area. So 593 is the purchase price. Rent 393 and yield 3.44. So not a great yield compared to some other areas, but going to be big upside. Units to houses, there's no units in the area. Renters to only owners, only 10%. We get a lot of mine workers and so forth who really they lap up the affordable housing up there. So there's demand for rent, but the it's predominantly owner occupied, and again, that's what we're after. So stock on market, very low stock on the market. Top left hand corner, building approvals, hardly any. The inventory of houses is hardly any on the market, and days on market steady. So I think this is an area that's holding, and the increase will come, but it's not immediately. And that's okay. So 1 month 0.71%, first quarter 2.79. By the end of the year, 12 months from now, we're expecting a big spike, around 16%. A lot of that's driven by it's just the next area that's going to appreciate in value. All those other areas have already kicked off. This is next place we feel it will go. So 3 years 59%, 5 years 127%. I'd probably be getting out about that time because it'll only go up another 10% between 5 and 10 years. So again, that's where you have your property reviews. All right, number one, I'm sorry, Adelaide's done it again. Freeling, South Australia. So this is further out than East Gawler, which we talked about before, but you'll see why in a minute that we're talking about this area. So the extension goes out to Gawler East, and then it's just a bit further on. But so we expect 144% growth over 10 years. Low vacancy, 1.88%. Low inventory, 0.38%. And stock on market, 0.14. So there's nothing available. URSAD's 3. Look, you don't want to go too much lower than that. But what I think is going to happen is there's going to be people are going to get pushed out into these areas with higher disposable income. And I think more people will travel into the CBD from here because of the new expressway out to Gawler. Yield 3.47%, so okay, and a balanced hold period. So here's what we've got, 10% in the first year. So you can see they've all changed at different rates. And again, it's machine learning where our best estimate of when it'll kick, but the real kick is going to be between 3 and 5 years. It'll go up from 51% growth to 105 and then 144 year 10. Again, we're 80% right in hindsight. Hindsight's a wonderful thing, but it doesn't necessarily apply to the future. All you can do is mitigate as many risks as possible, diversify your portfolio, and hope like hell that you've done the right thing. So renters to owners 13%, units to houses 2%. You're buying for under 700,000, which is hard to do. See, so inventory plummeting, it's under 0.5%. Stock on market non-existent. Building approvals, um, it's still limited. You're only talking hundreds of thousands of dollars. Yet there's not a big development that's going to come on, a greenfield development that's going to flood the market with supply that it can't keep up with and flatten it. So, and vacancy rates under 2%. So again, any of those areas, and they could all suit you for different reasons. Like you might already have an investment in Queensland, people have invested heavily there. You might want to diversify in Adelaide. You might be sick of the land tax in Melbourne and jump out. So if there's any questions, feel free to reach out. You know who we are, you know how to book a meeting with us. Isa heads up the lending. I'm the strategy guy, and I can help with where and what to buy based on your circumstances. We're always here to help. The other thing we can do is review your existing property portfolio. A lot of times, just getting an understanding of where you sit might give you some more confidence. Go, okay, well, this area, even though we haven't seen some growth, the indicators are maybe that stock is dwindling and demand is starting to increase. So it might just be biding your time, or it might be that you've had an underperforming asset, and it may be that your initial purchase was done off glossy marketing brochure, or there was nothing you could do. There was developments that come up in your area that flooded the market, or we're always learning. So it might be right at the time, but the best thing you can do is probably get all the information and make a decision. Look at it fairly and squarely, because we need time. Time in the market's critical. So making the best decision you can now with the information you have at hand is what I recommend. Any questions and answers, please feel free to ask, or put it in the chat if we have any questions. I might stop sharing my screen. No questions as it. That is all. If you want any information, any property reports, please reach out. Here to help. Thank you very much for attending. We're going to, an announcement is we're going to start a podcast shortly, and our YouTube channel. So we're going to deliver some more information through those channels, so you'll be able to ask questions. Hang it on me and the team. Anything you want to know, reach out. Any suburbs, etc. Reach out, ask a question. We can do it on air. Thanks for your time, everyone. We shall speak soon. Bye for now.